Abhishek Kapoor joins us now, CEO with Puravankara. Let's take a conversation forward with him. Abhishek, good morning. Thank you for joining us. We're getting a mixed picture on as to what the demand trends are. There is a case that demand has come back on a all India basis, but there's also data which we've just got from some rating agencies which are saying that real estate prices in pockets like Hyderabad, Bangalore have peaked out. What is your understanding of the big picture first?
See, I think it's too early to make a comment on the pricing and saying that it has peaked out. Our view is at this point in time on the ground, we are not seeing any significant change either in demand or sales. The way we are looking at it is that there is obviously a lot of talk, and especially the sentiments because of increased inflation and increased interest. But if you really do the math at the granular level, you will see that the impact on the consumer is not so much. And then let me explain to you how I'm saying this. Imagine now if you're buying 1 crore apartment, you would take a 80 lakh rupee loan, and your EMI per lakh was say about 760 rupees about a month back. That number changed by 50 bips. It's changed to about 809 rupees. So maybe about 45, 50 rupees is the impact per lakh per month. What does that mean? That basically means is the impact is about 4,000 rupees per month. Having said that, with the increased salaries, which have happened anywhere between 10 to 15%, the salary increase of household more than compensates for interest rates. So we're actually not seeing any significant impact as far as demand is concerned, and therefore it's too early to talk about price peaking out. And all of the markets that you mentioned, which is Bangalore and Hyderabad, I think there is a huge IT sector, service sector, and then there is a local economy, which is really a big growth area. I think that continues to be seen. Yes.
Now there is a collection of 2231 crore during the year, but out of the pre-sales figures, how much have you collected? And do you think the revenue recognition will be places going ahead as well?
That's a good question. So for us, last year was fantastic from operating point of view, from collections point of view. Operating collections was less 500 crores from the number you gave, which is in the range of about 1,700 crores. Because of the focus on delivery went up, we also saw, these collections go up. Because what this means is that while we ran out of our ready to move in inventory, we sold a lot more under construction. But with the progress that was going on, we were able to collect a lot. So in that sense, it was a positive year for us. And in fact, we reduced our debt by 450 crores and interest cost by about 139 basis points last year. Credit rating also went down. So we are quite happy with the numbers and the sales that we have done, because our under construction sales went up by about 50%. While our ready to move in inventory, because the choice was not available, the inventory was not available, came down by 67%. So we more than compensated with new launches and sustenance. So overall, last year has been a very, very positive year, especially towards the end of the year. We were able to spend a lot more, basically construct a lot more than we were doing earlier. So our operations were pretty streamlined by the last quarter last year.
Good morning, this is Nayantara joining in. So you've been able to construct a lot more. The question now will be, will you continue to launch a lot more going forward at a time when inflation pressures are there, there's pressure on the wallet? Can that impact buyer sentiment? And let's also not forget, home loan rates are also going to go up, and they're going to get costlier as the year goes by.
That's a very good question. So in our view, if you look at the supply side, there are a lot of constraints. Ready to move in inventory is pretty much over. The supply overhang we used to talk about a year and a half back is pretty much over. That is one. Second is that, today there is a lot of consolidation that's happened, both of the customers in terms of who they want to buy from, and also of capital. So that creates a lot of limitations in the market on how much supply will really, really hit the market and how much will get absorbed, and who can bring the supply in the sense that who will the consumer buy from. Now, as far as our organization is concerned, we are pretty clear that, we have about 50 million square foot in our portfolio. We're very clear these are bought lands. Here we have already put in equity for these projects. As far as land is concerned, all we need to do is put money in for sanctions and launch. And there's obviously good margins. So from that point of view, we are very confident about our launch pipeline, and we will continue to launch. The other reason why we will want to do that is also because we have a diversified geography, and we are in 9 cities. We are not concentrated in one geography. That allows us the flexibility of doing multiple launches in multiple cities and multiple asset classes. So we are in affordable housing, we are in plotted development, we are also in premium luxury housing. So that allows us to do multiple launches in multiple markets. So from our strategy, I don't think there is any change. We will go ahead with our plan. And as far as interest rate is concerned, let me just again reiterate, 100 basis point increase is going to result outer limit of 100 rupees per lakh increase in the EMI per month. And if you do the math, you'll realize that the impact compared to the increased salaries is not that significant. So housing for a change has really come back because there is a lot of pent up demand which was there in the market. And with the consolidation and with branded players bringing products in the market, I personally believe that this trend will continue.
Then tell me this, since you're in every segment, because of inflation, will you maybe focus on the high margin business, which is plotted developments, that's high margin, or even luxury housing? And therefore, could the product mix of affordable housing come down?
Okay, so I think with the input prices and the challenges that you're talking about, there is a bit of a stability that's come back with government measures in last 1 quarter for sure. I mean, if you look at cement and steel prices, they have tapered down a bit. They become far more, manageable in that sense. So in that context, we don't see any significant impact of ongoing increase in input prices. As far as materials concerned, of course, on the labor side, because of its inflationary pressure, there may be some increased labor costs, and we'll have to keep that in mind to protect our margins. But due to supply side constraints, we believe that whatever increase in cost may be there, we are pretty much able to manage with our with price escalations, and therefore we don't see any impact on the margins. From our strategy point of view, margins obviously are different in different kind of projects. I mean, depends on whether it is a joint development or whether it is an outright, and basis the kind of development we take a call on the project. So there is no specific plan to say that we will focus on this category or not that category. Of course, plotted has been fantastic for us. We'll continue to focus on that because that turns around the capital very quickly. There has been a lot of demand in the plotted development. So that definitely is going to be our focus. But having said that, between Provident and Puravankara, we're very confident in the way we are looking at our projects and where we are located and the kind of product that we're bringing to the market, that we don't see any challenges as far as these launches are concerned.
So it's business as usual, carrying forward with the momentum that we have seen when it comes to launches, execution, as well as the mix between affordable housing, plotted development, luxury housing. Thank you so much for joining us live today on the show.